One of the great things about retirement planning is that if you do it far enough in advance, you can take advantage of some strategic opportunities to significantly improve your plan. In this video, we're going to look at a $1 million retirement plan, but more specifically, we're going to look at some strategies that can help reduce the annual income tax to zero throughout the 30-year retirement plan. Now, my name is Owen. I'm an advice-only financial planner, a CFP, and I'm the founder of Advice. More on the Advice platform later. This video is going to be a great example of how planning ahead for retirement can let you strategically structure your finances in such a way that it will significantly improve your plan. I'm going to be showing you 3 examples, all essentially the exact same. The only difference is how they chose to use their assets and resources either pre-retirement or post-retirement. The main example, and the first one that we're going to take a look at, is a $1 million retirement plan where they're paying zero income tax every year over the course of their 30-year retirement. They're going to be spending $80,000 a year and paying $0 in income tax every single year. In this example, there's going to be 2 opportunities that we take advantage of. One is the tax credits available in retirement, and the second one is the tax treatment of Canadian eligible dividends. We're going to be doing a deep dive video on how this dividend tax credit works and how it can lead to negative tax rates in some situations. So make sure you hit the like, subscribe, and that little bell notification icon so that you get notified when that next video comes out. Before we get into the example, let me quickly show you these 2 opportunities and how they work. The first opportunity that we're going to take advantage of is the tax credits available in retirement. Now there's 3 main ones that we're going to focus on. So one is the basic personal amount here, $16,000 at a federal level. Then the second one that we're going to take advantage of the age amount tax credit. That's available over the age of 65. It's worth about $9,000 at the moment. So combining those 2, we're already at $25,000 a year in tax credits. Now, the third one that we're going to take advantages of down here is the pension income amount. That's available over the age of 65 on RIF and LIF income, as well as defined benefit pension income. That's worth $2,000 a year. So combined, $16,000, $9,000, and $2,000 gives us about $27,000 a year in tax credits per person. For a couple, that's $54,000 per year in available tax credit. That's going to be the first thing that we take advantage of in the plan. Now, the second opportunity that we're going to take advantage of is the way that Canadian eligible dividends are treated from a tax perspective. So in the province of BC, which is where our example is going to be located, you can see here that the lower income levels have a negative tax rate on Canadian eligible dividends. That means that the more income you earn within these 2 tax brackets, the more income you get from Canadian eligible dividends, the lower your tax ends up being. So this is a great advantage, and we're going to take advantage of that in the example. So this is a bit of a sneak preview of the plan, but let's take a look at the discovery phase just to see how we set this all up. So we've got the simple mode here in the income section. We just have to enter their CPP and OAS income. David and Linda here, they are 65 at the moment. They've started CPP and OAS. Combined, it's about $3,000 a month or about $36,000 per year. So definitely not the maximum, but still a fairly respectable amount, and about half of that $80,000 that they're looking to spend in retirement. So when we look at expenses, again, in simple mode, we're just entering in their total expenses on an annual basis. Very easy, $80,000 a year is what we're aiming for, and that's throughout the course of the entire retirement period. Now let's go over to assets and see what they have. In terms of assets, they've got about $20,000 in emergency fund, non-registered checking savings balance. They've got about, $340,000 or so in RSP RIF balance, and about $360,000 in their TFSAs, and about $300,000 or so in their non-registered account. Now, maybe the non-registered account, maybe it came from a home downsize, maybe it came from an inheritance, or maybe David and Linda were just looking ahead. Maybe they planned ahead and they realized that actually contributing to their RSP wouldn't be an advantage for them given their retirement plan. So again, planning ahead can let you make these strategic choices. So they've got a mix of RSP, TFSA, and non-registered assets. Now, the other place we want to look is the investment plan section. So we can see here that they've got an 80-20 asset allocation. So 80% in equities, stocks. They've got about 20% in bonds, fixed income. They've got a 1% fee. So maybe they're working with a portfolio manager of some kind. And they've got a fairly heavy weighting to Canadian eligible dividends in their non-registered account. So still some capital appreciation, still some capital gains here, but most of their return is coming from Canadian eligible dividends. Now let's jump down to the plan and let's see how this all comes together. And let me explain how we took advantage of some of these opportunities here within the plan. So we can see they've got $80,000 a year in total income. We can see the income tax is zero. When we look at their spending, we've got that $80,000 a year all the way across. From a net worth perspective, we're starting a little over $1 million. We're drawing that down over time. And from a success rate, we've got about 72%. That's pretty healthy, especially given they've got $700,000-$800,000 in home equity that they could always fall back on. So let's take a look and see how we put this income plan together. So let's start by hiding some of these income sources and let's build this up one by one. So let's hide the total income. Let's add the tax here. So you can see we've got zero tax every year throughout the course of retirement. That's a 30-year retirement, zero tax every single year. We've got Canada Pension Plans. We've got that $19,000 or so every year adjusted for inflation. We've got Old Age Security. Again, the combined is about $36,000, a little bit over every year. Now, the next thing that we want to add is their registered withdrawals. And you'll notice here that it's $16,000 a year. And that's specifically because we want to use up all the available tax credits that they're eligible for. So we've got about $36,000 a year in CPP and OAS income. We can withdraw about $16,000, a little bit more from their registered accounts. And that's going to use up all of those available tax credits that we talked about earlier. So let me show you how we did that. If I scroll to the right here, we've got our RSPs. And all we did is we just made an override and we just said, let's withdraw $8,000 a year over the course of the plan. That does end up shrinking the size of these accounts because it's over a certain withdrawal rate. But that does let us take advantage of all of those available tax credits. Now, if you had a smaller RSP, you might be withdrawing the $8,000. It might get wound down a little bit faster. If you had a bigger RSP, you might need to withdraw a little bit more just so that it doesn't grow in size over the course of the plan. But that's how we set that up to take advantage of all of those available tax credits. Now, the second thing we need to do is the TFSA withdrawals. So the reason why we need to withdraw from the TFSA every year is because we've got our non-registered account kind of full up with Canadian equities, Canadian eligible dividends. And one of the side effects of that is that we've got other asset classes in the TFSA and the RSP account. So we do need to equally draw from these different accounts. Otherwise, at the end of the plan, we're going to be super heavily weighted to Canadian eligible dividends or another type of equity investment. So we do need to draw down on all of these accounts fairly strategically here. So if I go down, we've done a similar override here. We're drawing $7,200 every year from this account, which is just the 4% rule. It's 4% of the 180,000 or so. It still grows a little bit every year, again, with that capital appreciation. But in general, we're drawing about 4% from the account every year. So that gives us the $14,400 from the TFSA. And then the last piece is just the non-registered account. So that gets us to the $80,000 a year. And over the course of the plan, the non-registered account does shrink slightly, but not too much. So we are taking out some of the capital gains. We're taking out some of the, or all of the Canadian eligible dividends, but we don't want to shrink that account too much because it is giving us the advantage of that negative tax rate. Now, over the course of the plan, that's how we end up getting this $0 tax. Now, you might be looking at it and saying, but Owen, there's $18 of tax there. I can see it in the lifetime totals bar. And you are right, but it all comes from the estate tax. So one of the things here is that we have this large non-registered account. It does accrue some capital gains over the course of the plan. There is a bit of a capital appreciation there. Remember, part of that gain every year in the non-registered account, part of it was Canadian eligible dividends, but part of it was from capital gains every year as well. So in the estate, once that entire $200,000 account gets unwound, there is a tiny bit of tax. It's only $18,000. It's quite small. And still every year in the plan, we've got zero tax all the way through. So over the course of the plan, extremely low tax. they've got financial assets of over $1 million, $1,020,000, and they're spending $80,000 a year, and there is virtually zero tax over this entire plan. Even in the estate, it's only $18. So this is a very, very efficient plan from a tax perspective, and overall very successful. $1 million, they're getting CPP and OAS, they're age 65, they're spending $80,000 a year, 72% success rate. Very, very attractive plan, especially because we've got that home equity they could always fall back on in the future. Now let's take a look at two other examples. I want to show you two other examples of where they maybe weren't making as efficient decisions, and we're going to see how that affects their plan. We're going to go to the compare section at the end. We're going to compare all three of these examples together. So let's first go over to the normal drawdown. So let's assume that they were doing a bit more of a normal drawdown. So maybe they're drawing down the registered accounts with a bit of an RSP meltdown. Maybe they're adding to the TFSA account every year. They're taking from the non-registered, adding to the TFSA account. That would be another logical thing to do. It's not a bad plan overall. There's definitely more lifetime tax, definitely more GIS, but we'll look at the compare section. We're going to see all of these different scenarios side by side, because the question is it better from an after-tax estate perspective? Same overall spending, but if we have a higher estate, we could probably support a higher level of spending. Overall success rate's roughly the same, so not a huge advantage there. There's probably some soft benefits to this. They have all of their registered accounts depleted by about 71, 72 here, so there could be an advantage if they're expecting maybe one of the partners to have a shorter life expectancy. But overall, I would say that this plan is probably not going to rank quite as well. Now, the other one I want to show you is, what if they had an RSP heavy sort of plan? So imagine that they didn't add to that non-registered account. So when we look at their net worth, imagine it was mostly registered and TFSA. And I'll show you the assumption we made. So rather than $300,000 in the non-registered account, we zeroed that out. We assumed that they added it to their RSP RIF, and we assumed that they added the tax refund as well. So we actually assumed that there's an extra $100,000 here. So instead of an extra $300,000, there's $400,000 in the RSP RIF account, because we assumed that they were adding the tax refunds to those accounts over time. So when they start their plan, they've got an extra $100,000 or so at the start of their plan, but overall the success rate is actually worse. Way more tax in this case, and we're going to see how this compares when we look at the compare section. But overall, I would say not as good a plan. Way more tax. Those registered accounts end up lasting until their early 80s. They do get some GIS benefits, so maybe there's some strategic advantage there. But let's take a look to see whether or not this adds up to overall a better plan. Let's take a look at the compare section. So let's go over here to the compare section. Let's take a look at maybe the zero tax versus the normal drawdown. So here, again, we're starting in the same position roughly, but we're ending up with a better overall estate value. And that's because we're doing a more tax efficient drawdown. And then if we add the RSP heavy one and compare it to the zero tax drawdown, yeah, we end up with a higher starting balance at the start of retirement. Again, we're getting the tax efficiency, we're getting the tax refunds of contributing that non-registered money to maybe a registered account pre-retirement. So yeah, we're starting with a higher estate value, but look at this crossover point. Already by the age of 74, the tax efficient scenario is coming out ahead. And by the end of the plan, we're still ending up with a higher overall estate value. And when we look at all of the different metrics, so here we've got a better plan funded ratio. We've got a better success rate in the zero tax drawdown. We've got way better tax. The only tax we've got in the zero tax drawdown is an $18 estate tax, virtually nothing, versus the maybe the RSP heavy one. We've got $135,000 in tax. After tax estate value, better in for all of the different situations. And so we've got more room to spend here. We've got more flexibility. We've got more room to spend, all because we were strategic about the way we were accumulating assets and the way that we decumulated those assets. It's just so much better. If we can think ahead, we end up with a better plan overall compared with the other different options. No change in income, no change in assets. It's the same total dollars. It's just we've used them in a better way in that zero tax scenario. Now, if you want to build a plan like this for yourself, just go to advice.ca. For just $9 a month or $49 for the year, you get access to the advice software platform, the AI strategies, our community forum for support, as well as our bi-monthly webinars. For just $9 a month or $49 for a year, it's incredible value. If you don't have a retirement plan, please go get one started, put a retirement plan in place, take advantage of the opportunities that we just went through. Thank you so much for watching. I really hope you enjoyed the video. Don't forget to like and subscribe, and we will see you at the next one.